Good evening, everyone. Welcome to tonight's webinar on the very important topic of legal business structures by the City of Los Angeles Department of Cannabis Regulation. My name is Frank Louie with the Cal Asian Chamber of Commerce, and I will be the moderator for tonight's event. Before we get started, let's take a moment to review some housekeeping for tonight's event. Please note that this webinar is being recorded and can be viewed after the editing process on DCR's website. You will be muted with cameras off for the duration of the webinar. This means that your camera and audio functions will not be available to you during the session. However, you will be able to see and hear all the panelists. There's an open chat box where you can interact with one another for networking or comment on the information. Please use caution when sharing personal information in the public forum and keep your questions focused on tonight's event. Please ask questions. We encourage you about tonight's subject matter in the Q&A box. We're gathering and responding to those questions throughout the presentation, and we'll have a Q&A session at the end around the last 15 minutes of tonight's event. You're also encouraged to utilize the Q&A box for your questions at the bottom of the Zoom screen. And this way, in the Q&A box, when we respond and answer the questions, everyone will be able to see the questions when they are answered. Finally, please note that the content presented tonight was not created for the Department of Cannabis Regulation by the Department of Cannabis Regulation or the City of Los Angeles and is for informational purposes only. This information is subject to change and does not replace or supersede the Los Angeles Municipal Code nor constitute legal advice. If you have specific questions outside of tonight's topic, please call 213-978-0738 during business hours to speak to a DCR representative. Now, I am pleased to introduce this evening's subject matter expert, Zachary Knox. He's the managing partner at Knox & Ross Law Group and leads the firm's cannabis practice group. Mr. Knox is considered an expert in this field and has spent over a decade advising and representing cannabis companies and entrepreneurs across California. In 2016, he was appointed to serve on the City of Oakland's Cannabis Regulatory Commission and continued to serve in that role through 2019, including serving as the commission's vice chair. Mr. Knox and his firm have been contract legal service providers for the City of Oakland's Cannabis Equity Program since its inception in 2017. The firm has since been contracted to serve programs in other cities such as Fresno and San Francisco, as well as outside of the state of California. Without further ado, I see Zachary has already joined me on screen. Welcome, Zachary. Always great to have you back.
Thank you.
Please feel free to start sharing your screen and with your presentation tonight, and we will turn it over to you. Thank you.
Absolutely. Thank you. And good evening, Los Angeles Equity. I'm so pleased to be here again. Thank you to the City of Los Angeles, the DCR, and the Cal Asian Chamber for bringing me back again tonight. For those of you who have joined us on the contracting webinars before, welcome again. For those of you who are here for the first time with us, I'm hoping that you get something out of tonight. Because we're going to be talking about something that's fairly important for you as you pursue your business ventures in cannabis. The cannabis industry has created a ton of new entrepreneurs entering the marketplace, particularly in the social equity space. And one of the most common questions that we get is, what sort of business entity is right for me? And so we're going to dive into that tonight. We're going to talk about a number of different types of business entities that your business, your company could be organized as. We're going to talk about the differences between them and some of the implications. And then at the end, we're going to share with you what we would normally recommend as appropriate structures for anyone who wants to get into commercial cannabis. So as you can see on the screen right now, we're going to cover sole proprietorships. We're going to cover partnerships, both general and limited. We're going to talk about corporations, as well as limited liability companies, And then, as I said at the end, we're going to make a couple of recommendations for those of you who are still trying to figure out what entity structure would be appropriate for your business. With that, I think we're just going to dive right in. Okay, so the first type is the sole proprietorship. And as you can see on the slide, this is really just you, right? This is you going out there and starting a business on your own. It could be in the form of a service business or a cannabis business or any type of business, but this is something that doesn't really have a formal structure to it. It's just you going out there and conducting business on your own. What it might look like in the cannabis industry, however, is you filing for a permit or a license solely in your name, as opposed in the name of a separate entity that you form. One of the disadvantages of going this route is that you, as the sole proprietor, are responsible for everything. You are responsible for the operation of the business. You are responsible for the compliance of the business. You are responsible to ensure that the business meets its obligations. You are responsible for any claims that are brought against the business, and you are responsible for any debts that the business owes. This is probably the most simplest structure, the least expensive structure, because it's really just you. But what I want you to walk away from is understanding that this is probably the least appropriate structure for anybody considering doing business, particularly in the cannabis business, because you are completely liable for anything and everything that happens. There is no limited liability protection, as we would call it, for anybody who starts their business as a sole proprietor. You are fully responsible for everything. Simple, easy, fast, but comes with a host of potential liability if you're not careful. In addition to the liability issues, equity investors typically will not put their money into sole proprietorships. This is another reason why it just doesn't work in a capital intensive industry like the cannabis industry. What you are asking an investor to do under this scenario is really to buy into you. You can't really sell off a piece of yourself. And so how do you structure this? At the end of the day, it's just really not feasible. And without some proper organization or structure, equity investors are going to run from you. The next form we're going to look at is partnerships. And as you can see in the diagram on the screen, particularly in general partnerships, this is you and somebody else. It may be a formally organized partnership, or it may be an informal partnership. But the significance here is that in a general partnership, all partners are on equal footing, and they generally have equal participation in both the management of the business and the distribution of proceeds coming out of that business. So for example, if there are two partners in a general partnership, that is typically a 50-50 split. Similarly, if there are four partners in a general partnership, that's a 1/4 split each. And they all have equal participation in management and in distribution rights. Now, if that sounds appealing, I just want to remind you that while general partnerships do allow for more than one owner, they still suffer many of the same weaknesses found in sole proprietorships, right? That liability that we were talking about, that fully fixes to general partners as well. General partnerships do not afford you liability protection. As an owner in a general partnership, you remain just as liable for the debts and claims brought against the business as though you were a sole proprietor. Limited partnerships were developed as sort of a response to general partnerships. And the reason why is because despite the challenges of general partnerships, this was a way to bring in additional resources, additional personnel. However, equity investors tend to shy away from general partnerships because they don't want the additional liability associated with being a general partner. They've already put up their money. They don't want to be on the hook potentially for additional liability because the partnership couldn't meet its obligations or a claim was brought against the partnership. So consequently, the concept of a limited partnership was developed. And in a limited partnership, you have to have at least one general partner, and that general partner still has all the liability obligations that would be associated with a pure general partnership or a sole proprietorship. But a limited partnership could also include limited partners. And the advantage here is that a limited partner does have some liability protection. Unlike the general partner, a limited partner is only on the hook for what they've put into the business. They don't have the same risk that a general partner would. But there are other limitations associated with limited partnerships that renders them not as attractive as some of the entity structures that we're going to talk about later in the presentation. In a limited partnership, the distribution of proceeds is not necessarily apportioned equally amongst the partners. This is something that can be negotiated, but the general partner generally has control of the business. And so I want to be real clear about this. Limited partners often do not have the same participation, if any participation in management, that the general partner has. So that's one of the trade-offs that a limited partner is making under this context. They have less participation in management, but they also have less risk associated with that participation in the business. And in terms of distributions, that can be subject to negotiation. Again, this does afford equity investors some liability protection that they tend to look for in risky businesses, like cannabis, for example. But one of the problems is they're putting in money, but they don't really have any participation in management. And so that is something that they're going to have to address here, right? As I said, this gains traction as a model because of that limited liability for the limited partner. But without the management participation, how can they realistically conduct any oversight over the general partner? The general partner in this scenario has nearly all decision-making power. And what we found is that equity investors tend to shy away from that model. Consequently, many investors favorite corporate formation or LLC structures over limited partnerships because of this exact issue, the lack of oversight and power over management that's afforded to the general partner. So we've gotten through 3 structures so far. We've talked about sole proprietorships, we've talked about general partnerships, and we've talked about limited partnerships. And one of the weaknesses that continually comes up is the lack of liability protection. So just so that we're clear before we move on, I want to spend a couple minutes just talking about limited liability protection and the importance of having that in an industry like the cannabis industry. So whether you're a sole proprietor or one of the general partners in one of the partnership structures I described, you do not benefit from limited liability protection. And without that limited liability protection, you as an owner of the business remain personally liable, not only for the debts of the business, but any claims brought against the business. So what does that personal liability mean? If the business cannot afford to pay its bills, then the creditors can come after you personally. They can go after your assets. They can try to levy your bank accounts. If you own real estate, they can put liens on your property. They can go after you personally without that limited liability protection. Similarly, if there are civil judgments taken against the business, whether it's for an injury or a labor violation, and the business cannot afford to pay, or maybe the business is underinsured, then whatever is not covered or whatever cannot be paid also becomes the financial responsibility of the owners. This is something that you want to avoid. This is the importance of limited liability protection. It protects you, your assets, and your family from having to answer for the debts in connection with the business, or claims for that matter. This is the reason why many business owners prefer structures that afford them limited liability protection. It shields their personal assets from debts and judgments against the business. And that's the limited part of it, right? The limited part here is that as an investor, you are only responsible and only liable to the extent of the capital that you have already invested in the business. So if you put $50,000 into your business, and that's how you capitalize your business, and you have limited liability protection, right? Let's say that business has a claim brought against it for $100,000 that's reduced to a judgment. To the extent that that $50,000 you invested could answer that claim, that gets paid out. But the other $50,000, the margin that the business could not answer for, you as an owner are not responsible to step in and cover that loss if you have the limited liability protection. So if you get nothing else out of this webinar tonight, please understand that as you're looking to organize your business in this industry, the limited liability protection is critical and needs to be in place. So let's talk about some of the limited liability structures, or I should say the business structures that afford you limited liability protection. And the classic is a corporation, right? So what you see here in the diagram is that the owners of a corporation, rather than being in partnership with each other, are represented by these eyes at the top for investor, right? In a corporation, the owners own shares of stock. The stock of a corporation represents the ownership interests, right? And what you can see from the diagram is that the investors, who are the owners of a corporation, sit at the top of the hierarchy here. Now, the owners, unlike partners in a partnership, do not necessarily run the business, at least not in their capacity as owners. Rather, a corporation is managed by a board of directors who the owners elect and task with running the business. Now, it may be that one of the owners sits on the board or even plays a day-to-day role in the business, but those are outside roles. They do not serve in those capacities purely on the function of them being an owner in the business, okay? They delegate the responsibility of running the business to the board of directors, who is charged with running the business for the common benefit of all the investors, of all the ownership, right? So the investors own the corporation. The board of directors is tasked with managing in running the corporation. Now, what's common is the board of directors may often delegate the day-to-day management of a corporation to officers and executives. And so that's the bottom of the hierarchy that you're seeing on the screen right here. The investors elect the board delegates authority to the officers and executives, who then manage the day-to-day operations at the pleasure of the board. Okay, so that's the hierarchy of a corporation generally. Corporations also need to follow certain prescribed corporate norms. So if you're going to be afforded the limited liability protection that we talked about a few minutes ago, the law is going to require that you meet certain norms around how you conduct business. So for one, by law, as we discussed, a corporation must establish a board of directors. That board of directors must conduct regular meetings and keep minutes of those meetings, meaning they need to take a record of what was done at that meeting. A corporation needs to hold periodic elections for its board members. That could be once a year, it could be every few years. It's sort of left up to the incorporators to decide how they want to structure the elections, but the board members are typically up for election. And then, of course, there needs to be at least one meeting of the shareholders every year. If for no other reason, just to elect board members, by law, you must have at least one meeting a year. The importance of these corporate norms is that if you fail to follow them, your corporation may be stripped of its limited liability protection. So you can think of it as jumping through the hoops. You can think of it as going through the motions. As you grow your enterprise, you will realize how important following some of these norms are. But the significance here is that if you don't follow them, you run the risk of losing the protection that you formed a corporation for in the first place. So let's talk about the two types of corporations that are available here in California. There are more, but we're going to focus on two primarily for this conversation. The first being the subchapter S corporation, what many people refer to as an S corp. The S stands for small, but don't let that fool you into thinking that this means that the corporation doesn't make a whole lot of money. There can be small corporations making millions and tens and hundreds of millions of dollars. Rather, that small, that S, stands for or pertains to the number of owners allowed on an S corporation's cap table. So to qualify as an S corporation, your business must meet certain requirements. Number one, you have to be a domestic US-based corporation. No foreign corporation can qualify as an S corp here. You are only allowed to have certain types of shareholders in S corp. Your shareholders, your investors, they must either be an individual or a certain type of trust or an estate. No partnerships are allowed to be shareholders in an S corp. No corporations are allowed to be shareholders in an S corp, and no non-resident alien shareholders either. So there are some limitations on who can be an owner in an S corp. In addition to that, there can be no more than 100 shareholders in an S corp total. Now, if certain shareholders are husband and wife, husband and wives count as one for calculating up to 100, but there can be no more than 100 shareholders. As an S corp, you can also only issue one class of stock. So we talked about the stock being the representation of ownership in a corporation. As an S corp, you can only issue one class. And we'll talk more about the significance of that when we get to C corps here in a moment. Also, to be an S Corp, you can't be an ineligible corporation. And I know that sounds a little bit wonky here, but what the law is really saying is that there are certain types of businesses that we're not even going to allow to be S Corps. And so there's some examples of those here on the screen. Certain financial institutions like banks or savings and loans, insurance companies, and certain import-export sales businesses are not allowed to be S Corps. Okay. One of the benefits of the S corporation is that the owners are shielded from the personal liability for the debts of and judgments against the business. But because those same owners also get to vote on who sits on the board, it preserves some of their oversight in the ownership level in a way that is not preserved in a limited partnership, right? In this scenario, they can help determine who sits on the board and thereby help determine the direction of management, and at the same time benefit from that limited liability protection. I think there's one other point that we need to make about S corporations before we move on to C corps. And that is that S corporations are what we call pass-through tax entities. An S corporation will file a tax return, but doesn't actually pay any income tax itself. Rather, what it does on its income tax return is report gains and losses out to the individual shareholders, who then have to report their personal gains and losses from the business on their individual tax returns. So that's what we mean by pass-through. The liability or the obligation to pay taxes on the earning of the S Corp flows through the S corporation directly to the shareholders, who report and pay that tax obligation on their individual returns. This is significant, and we're going to come back to it later. All right, so the other type of corporation that we're going to talk about tonight is the traditional C Corp. Some people don't even call them C Corp. They just call it a corporation. This is the traditional corporation that everybody thinks of when they say corporations. C corporations do not have the limitations that S corporations have. They can have any number of shareholders with very few limitations. They can create any number of classes of stock. They might have a preferred class for capital investors. They might have a separate class for founders. Sometimes in the cannabis space, particularly in the equity segment, they'll create a shielded class for the equity partners. Coincidentally, if you've been to some of our other webinars, you'll also know that they use these multiple classes to create predatory scenarios for equity partners as well. So you always want to be cognizant of what the rights are associated with the class of stock. But in a C corporation, the company can create multiple classes with different rights and privileges. And even within a class, they can create multiple series of securities that have different rights and privileges. The benefit of that is that there are very few limits on how much capital a C Corp can raise. So when you listen to the news and you hear about some company raised millions, if not billions of dollars, chances are they are a C Corp. Finally, a C Corp can be formed either domestically or in a foreign jurisdiction. There is no limitation on the jurisdiction of formation for a C Corp. Now, I mentioned that S Corps were pass-through entities, and I made sure to bring that up because C Corps are entirely different. They are not pass-through entities. C Corps are subject to what we call double taxation. What this means is that your corporation will file an income tax return every year, but it's not an informational return this time. The C Corp will have to pay taxes on its profits and its gains each year along with its tax return. This is what we call the first level of taxation when we say a C Corp is in a double taxation regime. So the C Corporation files its tax return, it pays its taxes, its income taxes specifically, I should be clear about that. We're talking about income taxes. Thereafter, if the C Corp pays out any dividends to its shareholders, so at the end of the year, it's reconciled all its accounts, it's paid its taxes, and there's money left to pay shareholders, so the corporation goes ahead and pays out to the shareholders. Those shareholders then have to report the dividends they receive on their individual tax returns and pay taxes that may be due on those dividends. This is the second level of taxation, and it gives rise to the name double taxation regime. So those of you operating a C corporation anticipate that when it comes to income taxes, there will be an obligation to pay twice. Once at the corporate level when it files its return, and then once at the individual owner level, presuming that the corporation was able to pay out any dividends to ownership. So I think this is an important point that's being made on this slide. While double taxation appears undesirable at first glance, right? Who wants to pay taxes twice? It is incredibly important in the cannabis industry. It is just incredibly important. We'll touch on the reason why at the end of this presentation. So moving on, let's take a look at our last business entity structure. And this is also the newest of these business entity structures, and that's the limited liability company, often referred to as an LLC for short. This is really a hybrid structure somewhere between a partnership and a corporation. And they were created as a direct response to the governance and administrative burdens of running a corporation. So some of the nuances of an LLC: instead of shareholders, the owners are called members, and they hold membership interests instead of shares of stock. Just like stock can sometimes be represented by certificates, membership interests in an LLC can be represented by membership units. And you can think of those membership units as the LLC's version of shares of stock. Like shareholders in a corporation, the members of an LLC get limited liability protection. I mean, heck, it's even in the name, limited liability company, right? So the LLC affords its members limited liability protection as well. However, there is one difference from corporations, and that is the flexibility that an LLC often affords to how it's managed, how distributions are handled, and the relationship amongst the actual members of an LLC. If you take a look at the right of the slide right now, you will see a few different structures for an LLC, right? You can be a single member LLC, in which case you are managing the business and running the business almost like it was a sole proprietorship. But because you registered as an LLC, you get that limited liability protection that was missing from a sole proprietorship. The LLC can also be either member managed or manager managed. Now, in a member managed LLC, all the members participate in the management of the business. typically in proportion to their percentage interest in the business, but not necessarily. And so a member managed LLC you can think of as being similar to a general partnership. The difference being that in this scenario, the partners also get limited liability protection, right? So under a member managed LLC, all the different members, all the partners participate in management together. This is different from a manager managed LLC. In a manager managed LLC, the members appoint somebody or even potentially a group of people to serve as managers for the business. And if this starts sounding like a corporation to you with a board of directors, you are spot on. Typically in a manager managed LLCs, the members sit back and be owners, the same way shareholders in a corporation sit back and be owners, with their responsibility being oversight and election of managers that they want to manage the LLC on their behalf. Now, as with a corporation and its board of directors, the manager or managers of an LLC could be comprised of people who are also members, but they doesn't have to be. You can have independent third parties come in and serve in that management role, the same way a corporation could have independent people come in and serve on its board of directors. In some situations, the LLC will farm out its management to a whole nother company entirely. And so you can sort of see what that might look like at the top of the screen here. One of the other benefits of an LLC is that they do not have to observe many of the same corporate norms that a corporation must observe. They don't have to have regular manager meetings the way a corporation has to have regular board meetings. There is no requirement that they have an annual meeting of the members, although it's highly advisable that they do so. So one of the beauties of an LLC, particularly when you're small and you're trying to get started and lift it off the ground, is that you don't have to carry as much administrative burden. You don't have to follow all these corporate norms that you would otherwise have to follow as a corporation. And so that affords you some flexibility in how you manage the business. Now, LLCs, similar to S Corps, are treated as pass-through entities for tax purposes by default, right? And I said they're a hybrid between partnership and corporation, but by default, they are treated as a partnership for tax purposes. So just like with an S Corp, they will file an informational return at the end of the year for income taxes. They do not make any payments themselves. And then they'll issue its members a Form K-1, which reports that member's proportionate gains and losses from the LLC's business for a year. And then those members would report those gains and losses on their individual tax return. And that is where the taxes would be paid. So no double taxation under an LLC, which is treated like a partnership by default. That tax obligation passes through, as we discussed, to the members. Now, one of the differences is that an LLC can make an election to be treated as a corporation for tax purposes. It doesn't change the nature of an LLC, doesn't all of a sudden start kicking in corporate norms that the LLC must follow. It doesn't require the LLC to establish a board of directors at that point. They're making an election to be treated as a corporation purely and solely for tax purposes. Now, you might ask, why would an LLC volunteer to subject itself to double taxation treatment? That's a very good question. We're going to jump into it right now as we get into our recommendations. So for this industry, for cannabis, I really think that there are only two viable options. You're either going to form as a C corporation, or you're going to form as a limited liability company, making the election to be treated as a C corporation for tax purposes. Now, you may be wondering why I am recommending two structures here that both have double taxation, as much as double taxation sounds undesirable. And it gets back to that concept of limited liability protection. Everybody wants limited liability protection. I can't understate how important that is. You should want it. Your investors will want it. Partners will want it. It is incredibly important to protect yourselves. Now, although an S Corp and an LLC not making an election both provide owners limited liability protection, there is one exception and one caveat to that. Because they are a pass-through entity, the entity itself never had any liability for tax obligations, just tax reporting. The liability for tax obligations always rested with the ownership in a pass-through entity. So unless you are a C corporation or an LLC making this election, you as an owner are still responsible for the tax obligations of the business, even if every other liability is limited. And what I will want to remind everybody is that Internal Revenue Code 280E still applies here in cannabis. Cannabis is still federally illegal. What that means is that any business operating in cannabis is at high risk for audit, is at high risk for a tax deficiency determination. And for those of you who are not familiar with that, that typically happens after an audit when the IRS decides that you either underreported your taxes or you took some deductions that they're going to disallow. Or even if you reported your taxes accurately, let's say that the business was just not in a position to pay its full liability. And so you had an underpayment. Any one of those scenarios can run into a tax deficiency determination. And if your business is a pass-through entity for tax purposes, you are going to be held personally liable for any of those unpaid taxes. So we can feel one way or the other about the double tax regime that C Corps and LLCs making the election are subject to. It is the only way to reach comprehensive liability protection. The standard corporation, the standard LLC will give you protection against creditors. It'll give you protection against civil judgments, but they will not necessarily give you protection against tax liability. So for those of you who are looking for comprehensive liability protection, these are the two forms that will do it for you: the C corporation and the limited liability company making the election to be treated as a C corporation for tax purposes. So that concludes the presentation. For those of you who still may have more questions about this subject matter, or business formation generally, or contracting generally, I would invite all of you to take advantage of the office hours that we are making available through the DCR. Feel free to go online and schedule a free no-cost consult to yourself by visiting equity.knoxrosslaw.com. And thank you for your time.
Zachary, thank you as always. Wonderful content, wonderful presentation, and a lot to unpack there. And a couple of questions, couple of clarifications, couple of questions. We'll spend the next few minutes diving into those. I'm just curious there. I mean, my experience and others that have been participating in this space, helping entrepreneurs, there are so many varying structures that people have formed. Is it conflicting advice that's out there, or do you think it's just maybe limited education so they can hone in on what's the right thing? Because you see so many different structures out there, and I'm not sure why, right?
Yeah, I would say that oftentimes if I don't see a C Corp or I don't see an LLC making the election, it's really a lack of understanding about how 280E applies in this industry, and what the implication of that is. And for the benefit of the people on the call, if you're not familiar with Internal Revenue Code 280E, it is the portion of the IRS code that governs the taxation of cannabis businesses. And for me to just simplify what it means, is it essentially says, even though we consider cannabis to be illegal at the federal level, we still want to collect tax from you. And oh, by the way, all the business deductions that you would normally enjoy in any other industry are generally going to be disallowed. So what you find is that businesses in the cannabis industry are often taxed at a much higher rate than any other business. Now, tax law and tax court litigation in particular has led to the allowance of some deductions, right? So if you can capitalize certain expenses into your cost of goods sold, there is some deductibility there. But if you are not a 280E accountant, I would not rely on your own determination for what is deductible and what is not deductible. It will invariably lead to audit and potentially to one of those tax deficiency determinations that we were discussing earlier.
Yeah, great comment. And I would refer everyone back to the DCR's distance learning platform, where we did some really great webinars and workshops on 280E and taxes, and those are invaluable as well. So thanks for bringing that up. Zachary, given the fact that maybe people weren't well advised or weren't as well educated, they may have formed a certain structure when they went down the path of trying to form an organization or file with the Secretary of State. Are those easily changed?
They can be. They can be easily changed. There is some cost associated with doing a corrective filing with the Secretary of State, but if you just filed and it's not the form that ultimately you think it should be and you need to reorganize, that can be done. But what I would say is the earlier you can catch it, the easier it is. If you have already brought on partners and you've already taken investment capital, it can be a little more challenging to make a change at that point, because then you might have to get buy-in from your partners. Right. Similarly, if you've gone down the path of licensing and you've gotten as far as obtaining a license from the DCC, a state license, then certain changes to your structure may jeopardize that license, and you may have to you may find yourself having to reapply again. So the sooner you can make the change, the better. The sooner you can catch any mistake, the better. But if you catch it early, it may just be a matter of filing a couple of forms to get things corrected.
Great, that's good. That's good to know. And then another question in regards to the complexity of the cannabis space and the different vertical businesses you may start or enter into or pursue. Are there differentiations between structures that you might establish for a specific vertical inside the space?
So the way we look at it is that how you, particularly if you're a vertically integrated business, right? You may want to separate certain aspects of your business for risk mitigation purposes, for capital raising purposes. And so we've seen some of these umbrella structures where there might be a parent company and there might be subsidiary businesses underneath that umbrella that are each engaging in different types of licensed activity. I think the decision to do that is very situation specific. Depends on what you're trying to do, what you're trying to protect against, and what your strategy is to raise capital for those businesses. But I think for the purposes of this webinar tonight, the audience needs to know that there needs to be corporate tax treatment sitting somewhere between them as the owner and the actual operating entity. Conceivably, under that umbrella structure, all the subsidiaries could be pass-throughs, as long as the parent company, which sits between the operators and the owners, has corporate tax treatment. And that's the main thing I want to relay there, that the owners, the individuals, need corporate tax treatment somewhere between where they sit and where the licensed operation is taking place.
Great. Well clarified. And here's a couple other questions that have been submitted as well. You talked about the advantages and why you would want to set up the two structures that you mentioned. Are there any disadvantages to incorporating or forming an LLC?
Yeah, for lack of a better way to describe it, it's a pain, right? As I said, the sole proprietorship is the easiest thing. You just walk out and you start conducting business.
Right.
Once you start using these more formal structures, right, there's going to be additional expense associated with that, whether you're talking about filing fees, there are administrative costs, particularly if you're a corporation, you have to comply with government's norms to maintain your liability protection. There is the double taxation here, which is sort of disadvantageous, but those are some sacrifices that you make for the protection that you're seeking. So everything costs, right? I've often, flippantly said with my clients that hey, you form these structures because that's just another way you're insuring yourself. So yeah, you have to pay an annual fee as part of maintaining your business. Think of that the same way as you paying your insurance premium for your business. It's what you have to do to afford yourself the protection that you need.
Yes, agree. And getting used to having lots of either board members or managers or members that may be directing you in a lot of different directions, right?
Well, the minute you introduce other parties into it, there's always an opportunity for disagreement.
Yes.
I've sat on multiple boards. I've advised multiple boards. Headbutting is not uncommon.
Yes.
But and that would be, you would run into that in any of these forms the minute you start bringing in other people.
Yes. Well said. And here's another question. what do I need to do to file with the state to form a corporation or a LLC?
Great question. So the state of California has actually made this process really simple. You can now form your LLC or form your corporation. I should say register. You can register your LLC or your corporation with the state of California by submitting single-page forms nowadays, along with the filing fee. Those can be found right on the Secretary of State's website. I believe you can do it all online nowadays. You will find that some businesses still require manually drafted articles of incorporation or articles of organization. And that's what they call those. For a corporation, you need to file articles of incorporation. For an LLC, it would be articles of organization. In some scenarios, the single-page forms that the Secretary of State provides are not adequate. For example, if you are looking to have certain indemnification of directors or managers, that may require a custom set of articles to be drafted and submitted. And so, whether or not the baseline documents that the Secretary of State provides are adequate for you is something that you should probably seek legal counsel on. Mm-hmm. But it is a very straightforward process. You submit the articles, the state processes them. You are now registered, either as a corporation or an LLC. 60 days after that registration, you need to submit a statement of information. Mm-hmm. And on that statement of information, you will identify, in the case of a corporation, who the directors are and any officers, if there are any officers at that time. And on the statement of information for an LLC, if you are manager managed, you need to name all the managers. Or if you are member managed, then you need to name all the members. It's the way the state keeps track of who is responsible for managing these business entities. Yeah, that statement of information then has to be renewed periodically. So if you're a corporation, you're going to be filing one every year. If you're an LLC, you're going to be filing one every other year. But that is all the documentation that the state requires to register and form your business entity.
Great, thank you. Let's take a couple more questions here and then we'll wrap up. I think you referenced this in earlier in your presentation. What is a registered agent and why do I need one?
That's a great question, and it's a common question. So when you're filling out your LLC registration form or your corporation registration form, they're going to ask you to identify who your registered agent is. And this could be an individual who resides here in the state of California, or it could be an agency that's authorized to serve as a registered agent based here in California. Now, the role of that registered agent is they are the individual that the business names to represent the business in receiving government notices, as well as receiving service of process of any legal documents. So that is their role. They receive those things and then they transmit them on to the company.
Mm-hmm. Okay. Then we had a clarifying question submitted here, Dr. B, and you may have referenced this, Zachary, but how often do you need to file the statement of information with the state?
If you're a corporation, it's every year. Annually. And if it's an LLC, it's every other year.
Okay, great, thank you. And then final question. And this is, we've kind of all heard this. I'm not quite sure we all know what this means, but what does it mean to pierce the corporate veil?
It's a great question. And it's something that everybody should be cognizant of, right? We discussed at length the importance of limited liability protection. But that limited liability protection that's so important is not absolute, right? It can be set aside and you as the owners can be held personally liable in certain circumstances. So some of those circumstances are if you are commingling your personal assets with the business's assets, right? This is particularly important for single member LLCs when you're just running the show yourself. If you start paying your personal bills from business accounts, or you start mixing your personal money into the business account, that is commingling that can be used to pierce your limited liability protection. Another example for people who are new to this, signing agreements in your name as an individual rather than in your capacity as an officer, manager, or director of the business. You need to make sure that those contracts are in the name of your business and that you are executing them in your capacity as someone running the business. And then one of the big ones is fraud, right? If you are engaged in fraud, if you are deceiving your investors, that's a red flag right there. That'll get the corporate veil pierced in a heartbeat.
Wow. Yeah. So much to consider, and research and understand as you enter into that, really any space, any vertical as you start a business, but especially cannabis. And we do have a question that came in. Manuel sent in a late question. I know you talked a little bit about this, but is it better to file an LLC or corporation out of the state of Nevada or Delaware? I remember there's some limitations on out of state or not, right?
This is a great question, right? So I get questions all the time. Shouldn't we be registered in Delaware because they heard on TV or read somewhere that everybody registers in Delaware? So yes, there are advantages to registering in other jurisdictions, and I'll just get to the punchline. I don't know that it's going to help you here. People often register in Delaware because Delaware law tends to favor the corporation in corporate governance matters as opposed to the shareholders. Delaware law defers a lot to management of the business. That's why you see the biggest businesses in the country organized in Delaware. If you are going public and you're going to have millions of shareholders who might file a frivolous lawsuit in a heartbeat, you're going to want to be organized in Delaware where they defer to management. There are also jurisdictions that are tax advantaged. That's often where Nevada comes up. Nevada does not charge state income tax against businesses. Neither does Wyoming or Florida or Texas. So those are what we call tax advantaged jurisdictions. Unfortunately, I don't think any of that is going to help anybody on this call. If you operate in California, even if you're registered in a tax advantaged state like Wyoming, for example, California is going to want you to register as a foreign entity doing business in California. And they are still going to collect California tax on everything that you do in California. So if you operate in California, there really is no advantage to organizing somewhere else, with one exception. If you're a multi-state operator and you are partitioning your income across multiple different jurisdictions, then yes, it might make sense to be based out of a tax advantage jurisdiction. If you're going to go public, then yes, there may be an advantage to organizing in Delaware. You're still going to be subject to California law. You're still going to have to pay California tax. But once you become big enough to become an MSO or to IPO, the additional cost may make it worthwhile to you. But as long as you're a small operator, as long as you are only operating within California, there really is not much of an advantage to organizing elsewhere.
Well, great response, Manuel. I hope that that helped. I thought it was a very thorough and clear response and good advice. Zachary, as always, thank you. I thoroughly enjoy participating with you in these workshops. There's so much to learn, and I know that we put a lot into a short period of time for purposes of efficiency. But thank you very much. It was very very good and valuable, I am sure. And we'll talk a little bit about how you can get a little bit more time with Zachary as well. So I want to thank everyone for attending this informative webinar offered by the City of Los Angeles Department of Cannabis Regulation. This webinar was recorded and will be found on the DCR's website at cannabis.lacity.org. Once the editing and final reviews are approved. If you have any questions on accessing your account, please email dcr.sep@lacity.org. I would also like to remind everyone on the call about the one-on-one office hours and assistance. As you know, we're offering over 300 hours of free business, professional, and workforce development coaching with subject matter experts from a wide range of expertise. Coaching is available in the following business formation categories: contracts or business structures, commercial leases and negotiations. For businesses that need specific expertise, please schedule a 15-minute virtual assessment to determine next steps and reference to subject matter experts. And for job seekers, there are some free coaching opportunities as well on interview training and coaching for job seekers. I want to thank everyone for joining us tonight. Have a wonderful evening, and we'll look forward to seeing you on our next webinars. Thank you very much. Bye-bye.